So if you're going to draw a comparison with the 1970s, I think it's more like the early 70s than the late 70s, which might suggest, this is all probability and guessing, right? That if we're going to have that big blow off high in gold, it's more likely to be a bit further out than close, or if it is close by, it's going to be very dramatic because there's potentially a long way for it to go.
This is general advice, my opinions, and for entertainment purposes only. CFDs are high risk, past performance isn't reliable. I may be long or short CFDs and stocks mentioned. Content may contain language that offends some viewers. Righto, bag holders and stop loss haters. I said we're having a gold chat and we are delivering a gold chat. We're at about $5,000 an ounce. I want to know from this legend right here whether we're going to 4,000 or 6,000 first. Shorty Russo from Noah's Rule. Mate, welcome to LEVRD.
Hey, Matty. Lovely to be here, mate. Nice to see you again.
You too, mate. Good to see you last week, but we're going to really get into the weeds today because there's no man or organisation that I respect more in the gold industry than yourself and Noah's Rule. And, mate, you have been in the weeds doing some pretty deep analysis on, you're always good for a graph, you're good for some stats, and, mate, I want to hear what you've come up with of where we're at in this gold cycle. So take it away, sunshine.
Thanks, Matty. And look, we'll go through the slides. We'll go through the same slides I used in Frio last week because that really reflects really our kind of latest analysis and certainly my thinking. And I'll say now that some of the commentary is really about my thinking as an investor in this sector and trying to, as someone who's buying shares as well as advising mining companies, straddling those two things is really trying to understand. And as we'll see, we've seen metrics in the price, in how far it's run, in the kind of margins it's delivering to miners and things like that, where I have to go back beyond my working life. When I started in the gold market in 1984, I have to actually go back into the 70s when I was at high school and primary school to find similar conditions to those that we're experiencing now. And because I wasn't paying attention back then, it really requires, to go back and read and look at the numbers. And so I've been trying to look at some of the numbers and trying to make sense of it because I have seen some comparisons with the 70s and people think we're in the very late 70s and we're about to have that kind of 1980 high. To me, it feels a lot earlier, and we can talk about that today. And I think I'd start by saying in 1984, when I started in the gold market, it was $400 US and Aussie dollars on the way to about 250. And it had been 800 only 4 years earlier. And as a young bloke, I'm looking going, well, who on earth paid 800 and why? Only, 4 or 5 years ago, it's now worth 200. And you have to go back at that time, what inflation was doing, the Vietnam War and the implications of that for the US and what had happened. And then Russia had invaded Afghanistan. So there was a lot going on that I wasn't paying attention to at school. But there was I thought, to try to draw some relevance, there was a line I always remembered from a great Aussie crawl song, Beautiful People, about riding $200 push bikes in the park. And there was a lot of other things that they referred to beautiful people. They always had a Robert Palmer T-shirt and the travel bag, the house was full of plants, the garden was full of furniture, the house was full of plants, but that $200 push bike in the park resonated with me because what I was interested in the 1970s was owning a push bike. And I remember the kind of bike you could get for $200. So I was trying to think, well, what's the relevance of that? How expensive was a $200 bike back then? And the way to look at that's two ways. It's to look at it, what were weekly wages at the time, but also in gold to carry through, because obviously wages have changed substantially, but gold's, as you know, I think gold's that kind of long-term benchmark. That's why we look a lot at ratios. And so that's what we did. So maybe if you want to look at that, the first slide about sort of gold wages, if you want to put that up, is a good place to kind of start.
Send it, mate. Send it. Between gold silver ratio, gold wage ratio, bike to gold ratio, we're going to go through them all.
Yeah. So have you got that up on the screen now?
Yeah, mate. Just take it away.
So the album came out in 1980, and you can see there's a big spike in 1980 when gold price went way up. But the song was actually written in my deep research into this, Matty. The song was actually written in 1975. So if you look down there in 1975, 1 ounce of gold would cost about 1.4 weekly wages. That brown line in the middle is Australia. So 1.4 weeks to buy an ounce of gold. Now, an ounce of gold there was $120. So if you think about it in that context, then you were talking about 1.6 ounces of gold, almost 3 weeks worth of wages there, 2.6 weeks of wages to buy that bike. So you can see why they're looking at a bloke riding around on a bike like that in the park. They're going, that's a pretty expensive bike. Now, if we think about 1.6 ounces of gold today, that's up around $12,600, $13,000. Now, there's lots of mammals in Perth who ride around in pelotons and, do all their big trips to tell you $13,000 is not a lot to spend on a bike. But I think, as I said in Fremantle, whether it's 1975 or today, mammal or not, if you're riding one of those bikes around in the park, James Ray and his mates could fairly call you a tosser. You can buy a much cheaper bike than that. So I think, but it does give you a sense of how gold has kind of maintained its purchasing power in the first instance in the long run, that, an ounce of gold will still buy you, a very good bike today. And it bought you, a very good bike back then. But I think the other thing that's a little bit scarier is to look at that wages to gold graph. And you look right now, and this is very relevant to the current debate. Today, you've never had to work harder in the UK, Australia, or the US to buy an ounce of gold. So gold is either very high or wages are very low, right? One or the other. And it's probably a combination of both, and we'll see why. So for the average wage earner, there's no doubt that gold is very expensive. So these people queuing up at ABC Bullion and places like that, we've seen all that in the media, been a lot of hype about that. They're queuing up to buy something that's never been more expensive, which is really quite interesting and speaks to the kind of the sort of the mindset, or what is perhaps the fear. We're in the fear part of the trade, not the greed part of the trade, if you like, if that's what people are doing, because they're really having to spend an awful lot of money to buy, every ounce of gold's the same size as a 20-cent piece, so you drop $7,000, you walk out with a 20-cent piece worth of gold. It's interesting. So I thought when I was looking at this, that was the first thing that occurred to me. And I've been having a lot of debates. And when I saw you in Sydney recently at that Resource Rising Stars conference, I was having a debate with another old bloke who's very bearish gold. And he's bearish gold because he says it's too expensive. All the people in Asia won't be able to buy it. And if you looked in, Thai baht or Indian rupee or whatever, I'm sure right now it would be similar. In fact, their wages probably haven't gone as well as ours, which is why we've outsourced everything there. So it doesn't matter where you look. The average wage earner, gold is very expensive. I would say on the other side, though, there's very few people in Australia that have a significant amount of their savings in gold, or in the UK or in the US. But we know all over Asia that that's how they keep all their savings. So while Indians might find it expensive to buy gold today, or, people in Thailand or other part of China, their savings have gone up in value enormously, right, in the last couple of years. So this rise in gold price has created an awful lot of wealth, or a wealth effect in Asia, where their savings in some cases have doubled or tripled over the last 2 or 3 years. So they're obviously doing a lot better than us. They can't afford to buy the same amount now, but what they've got gives them enormous purchasing power in other things. But so I guess the other side, before we leave this slide, is you go back and look, we've also exceeded the Depression era, right? In 1935 is that other peak. And we know that, we had that boom in 29 and 1930. So we've got an interesting situation that we're kind of at the levels that we saw in the past. That was quite a different environment. 1980 was the end of a very long period of inflation. The 1930s there, 1929 was a long period of, hyperactivity and then the Depression. And so I look at that, and you look later when we look at other graphs, this is in a real contrast to other things. So gold is very expensive relative to wages, but we're not really yet in the kind of crisis, or it doesn't feel like we're in a crisis in the way that we were, in the 1980s or in the Great Depression. And I think a significant part of that is probably that interest rates have remained so low that although wages aren't great to buying gold, and they're actually not great buying houses either, but interest rates are low enough that everyone can just have a stonking great mortgage. So I think that's part of the problem in the West as well, right? That how have we been able to survive with wages that are the worst relative to gold they've been in over 120 years? It's because everyone's mortgaged up the wazoo to kind of have the same lifestyle that their parents did. So, I think that's interesting. And as we reflect on that in some other charts, you'll see. So, I just wanted to put those two arrows on those two blue arrows where James Rain and his mates were writing that song, A $200 Push Bike in the Park, and where we are today. And they'll pop up on other charts as we go through to kind of show you, just how different by other measures these 2 points in time look.
I'd love to see, before you go to that, Shawnee, I'd love to see a graph on the wages to median house price at the moment, because Jesus Christ, that must be off its head.
Well, it would be very similar. It would be very similar to that chart, Matty, in the sense of home loan affordability in terms of, how many months of earnings to put a deposit down or whatever. It would look very, very similar to that, right?
Yeah.
And in fact, and this will resonate particularly with Perth people, but in Double Bay in Sydney, or as they call it, Double Pay, there's a house up for sale at the moment that was the home of, for several months of the year, of Big Red, Eileen Bond, and it's going to sell for $17 million, they reckon, for it's a 4-bed, 2-bath, 2-car apartment on the harbour in Sydney. $17 million. In 1986, Ellen Bond paid $1.2 million for that apartment. And I did the quick maths, and it's about the same number of gold ounces.
Is that right?
So
there you go.
Yeah, so you've got a situation where in ounce terms, that house price has really just reflected the change in ounces over time. So in wages, yes, that house is off the chart, but in terms of gold is actually quite flat. Or Sydney property prices, harbourfront property prices are the same in gold as they were back in 86, which I thought was interesting.
Yeah. Mate, this next slide, this is the very interesting piece, the Dow Jones to gold ratio, the log scale, historically. Now, first question I have, because for those people that don't know, the Dow Jones is a price-weighted index. It's not like market cap weighted, like compared to the S&P 500. Why is this graph using the Dow Jones instead of the S&P 500, for instance? Is there a reason behind it, or does it alter the data at all that it's price weighted?
There are also, and you would go on, if you go on Twitter now or X, or anywhere else, you'll see lots of people producing similar graphs to this for the gold versus S&P.
Yep.
We choose to use the Dow Gold ratio simply because I'm fairly set in my ways, Matty. And when I first learned about this ratio from a bloke called Richard Russo way back in the 80s, he always talked about the Dow Gold ratio. And Pierre Lassonde, when he first came to Australia, he popularised this ratio. And the Dow Gold got a long history. It's blue chip stocks. That's literally the Dow Gold. The Dow is the sum of the 30 stocks in the indices. And so it gives you just a sense of, if you sold one of each of those shares in the indices, how many ounces of gold could you buy? And the other thing that's always sort of tickled my fancy with this chart, Matty, is the year I finished high school, 1980, it got down to 1-to-1. So 1-to-1. So you could sell your shares in the Dow, and you could only buy 1 ounce of gold. So that's at the peak of the gold, and when that gold wages chart was right at the top. And if you look at that blue arrow there, that just points back to 75. That's when James Rain was talking about $200 push bikes in the park, right? And we're on the first wave of there where it had gone below 10. And notice the line here, we're just at 10 today. So we're sitting around 10. I believe that below 10 bad things happen. That's just generally been the way of the world. There's certainly the big rally into 11 when we got down to 5. Remembering this is a log scale here, right? So
Yep.
10 to 5 is a doubling of gold relative to equities or a halving of shares. So in the early 70s, as they're kind of sitting there going, why are the rich people riding $200 push bikes in the park and we can't cope? That's because the average wage earner was doing it very tough. You saw it was going up and up. Rich people are always rich. I mean, they were talking about the people in Toorak. They've never been worried about what wages were, a bit like, as I said in my presentation, a bit like people in Peppy Grove. People who've got money have always got money, recession or not. But the workers were really feeling the pinch already in 75. And then, of course, we had just the total sort of malaise and collapse of equities. And it was really as much a collapse of equities at that time as it was a rise of the gold price until 1980. So I stick to the Dow Gold, Matty, because that's what I first saw, and I'm comfortable with the numbers and I remember the numbers. And so red a background is the falling ratio. That's good for gold. That's when gold is outperforming general equities, outperforming the Dow Jones anyway. Green is when gold is underperforming. Now, gold can be rising in a period of time when the background is green. Gold can rise alongside a rising stock market, but it's not rising as fast. And so the rational investor, and I'm not a gold bug, I'm a gold beast. I've been in this market for 41 years and I can be long, I can be short. I'm not wedded to the idea you have to have it. When that background's green, you really have to question why you would own gold if you could own other things that were improving your purchasing power. What is fascinating is to think that it went from 1 to 1 to 40 to 1 across that period from 1980 to 2000, right? So if Grandad had sold the 1 ounce of gold and bought the Dow in 1980, he could sell the Dow, those shares in the Dow, and earn dividends along the way. This doesn't take account dividends, which makes more favourable in the green periods. And he could have bought 40 ounces of gold, Matty. Sold 1 ounce and got 40 back 40 years later. That's pretty significant in the change. To think then another 11 years later in 2011 with those 40 ounces only cost him 11 to buy the Dow back, could buy 4 times as many stocks back. So, in these big cycles, you can see this is just a change in the relative purchasing power, and it tells you something about what's happening in the world. And I kind of think the way to think of it, and this is not an original idea, but I like it, gold is the measure, is the kind of the standard measure, because dollars keep on moving. It would be like if you were trying to build a building and the ruler kept on changing in length every year, your unit of measure. Pretty hard to build a building over 4 years if every year your ruler changes length. That's the problem when we compare things to dollars, because they're also moving and they're expanding in volume. So gold is your kind of more stable benchmark. So 10 ounces got you the Dow back in 71. It got you back in 95 there. It got it in 2009. It got it again in 2012, and it got it again today. So if that's your kind of median line, gold versus equities is about the same through that time. So really the question is, are we flicking over that line? Now, the reason I think this graph is very important relative to the wages graph is you can see that when that wages graph peaked in 1980, you can see where the Dow Gold ratio was, right? We're nowhere near that. Now, that wages ratio is now higher than that point in 1980. It's upside down, but the same thing. It would be lower if it was reversed. And I can tell you that back in the 30s, it also got back to 1 to 1. So it was also down there. So it's wages that's been the huge issue here. So the workers are struggling. But if you look at this from the perspective of investors and looking at a stock portfolio, they don't see gold as being expensive at these levels. Gold is expensive when it's in single digits, right? So we're still at 10. So I made the point in Fremantle that while it might be difficult to imagine wage earners buying gold here and driving a gold bull market, it's not hard to imagine, looking at history, that portfolio managers who are managing your superannuation, my superannuation, wealth funds for nations, all types of things, are looking at that red background, are looking at the ratio falling and going, I think I've seen this story before. And in their own way, they're not queuing up outside ABC, but they are selling shares to buy gold, and they have been really since that ratio started to fall dramatically a couple of years ago when it was above 16 there on the right-hand side. And already, just in the last 2 years, gold has massively outperformed the equities. And you think how high equities are. Equities are
just about to say that.
The Dow's at 50,000, Matty. So, yeah, so you've got a situation where I think institutional investors with huge amounts of money being managed, and they don't want to give it back. They don't want to underperform the market and have to give it back. No one wants to give back their AUM. So they're all desperately trying to outperform the market, and they see that gold is outperforming their benchmark. They become attracted to gold. And, you know, if they've been around since the 2000s, they'll remember how much gold outperformed between 2000 and 2011. And if they're not, they might be students of history anyway. But you look there and you go, it feels a bit to me like the 70s. It feels to a lot of people like the 70s, to go back to the beginning of the conversation and why I was, you know, I thought that James Rain or the Oz Crawl analogy was a good one. But it's interesting in as much as we aren't even near where the 75 levels were, let alone the 1980 levels. So if you're going to draw a comparison with the 1970s, I think it's more like the early 70s than the late 70s, which might suggest, this is all probability and guessing, right, that if we're going to have that big blow off high in gold, it's more likely to be a bit further out than close, or if it is close by, it's going to be very dramatic because there's potentially a long way for it to go. Gold could double or equities could halve here, one or the other, and we'd only be at the 2011 level where we got to 5, Matty.
Yeah. Because that's if you just look at where the money could flow at the moment, like because the NASDAQ, Dow, everything's so toppy. Like money could, as you say, money could just start flowing out of equities into gold as a more safe bet, not a geopolitical risk side of things. It just could be like, is our money safer in this metal right now than in these toppy indexes? Yeah.
And it's not just I haven't got the chart here. It's not just outperforming equities. It's not just outperforming the S&P. It's not just outperforming the Dow. It's outperforming bonds. And there's been a lot of stuff you would have seen about the 60-40 portfolio, you know, 60% equities, 40% bonds isn't working anymore. I think people are concerned about interest rates going up more than Trump wants interest rates down, but everyone else, I think, realises they're more likely to go up because the governments just keep borrowing more money. We know they're not going to get fiscally responsible anytime soon, right? So I think gold's also outperforming bonds. So if you just allocated 2% of all the money in US bonds, that's equivalent to all the gold, the dollar value today of all the gold will be produced by producers in the next 12 months. So, you know, like if people decided to allocate 2% of all the money that's currently in bonds in the United States, just the United States, the numbers I did would mean that they would have to buy every ounce that the producers produced this year. So everybody else queuing up outside ABC, every other central bank buying, everybody else is going to have to drive the price up to a level that the average Asian consumer that holds most of this stuff, you know, the little people in that part of the world that have massive savings in gold, to a price where they're willing to let it go. So my debate with the bloke in Sydney was, I hear you, the average wage earner is not going to drive the gold price higher. I believe institutional money and institutional flows is likely where that's going to be from, and I think this graph speaks to that. My question is, and this is the big question for producers in Australia and anyone holding gold, Matty, is there are 58 ounces of gold in the world for every ounce that will be produced in the next 12 months, sitting somewhere on the surface mined since the beginning of time, right? At some point, the gold mining industry will meet a point where its customers become its competitor, right? And mining companies can only produce a certain number of ounces every week, every month, run as hard as they can and hope. But the investors, if they change their mind, like they did in 1981 or they did in 2011-12, can sell everything they have in a week or a month and it'll push the price lower. They don't need to sell it on a weekly, monthly basis like producers do. So to go to my pet subject of hedging, you know, if you get to one of those peaks, Matty, if you're a gold mining company and you suspect that your customers are going to become your competitor, if you're not locking in some prices at that level, then you want to be battening down the hatches because there's 58 ounces out there for every ounce you collectively are going to produce in the next 12 months. So that's the flip side to all this. And that's why if the background turns green, I'm happy to go elsewhere, I'm not going to try and fight it. I mean, I always say, in Australia, you learn when you go down the beach, never swim against the rip, right? Like, never swim against the prevailing current. And at the moment, the current's absolutely in favour of gold over equities. And if we get through 10, I think it really could get exciting quite quickly. But that might be because equities halve or fall 30% on some kind of bigger, like .com style type bust in AI, right?
Yeah, yeah. And because so if that's the amount of gold in the world, correct me if I'm wrong, I think like the amount of, like, in reference to the debasement trade that's sort of happening now, and like, fiat currencies not being as important as they previously were, I think if people are trying to get out of currency, convert their treasuries from currency to gold, isn't there a multitude bigger amount of treasuries around the world than gold, like 100 to 1 or something like that? You'd know
Look, I don't know what the ratio is, but absolutely, Matty. We all know that every year the amount of gold, well, it's 1 in 58, right? If there's 58 ounces on the ground and we're going to add 1 ounce this year relatively, every ounce we're adding another 1 ounce to that 58. So it'll be 59, then it'll be 60, then it'll be 61 in 3 years' time, maybe 62 if the producers all get their act together. We know the governments are producing much faster than adding to the dollars than 2% per annum, right? We know that. You can look at all the money supply numbers and what's going on. So they're printing money faster than producers are producing gold. Gold's not getting destroyed. It's all there. If you hold on to gold and you know that they're producing all that extra money, you want more money for it, or you want something else. And so my thing is, I don't believe that Asia sells gold. I don't believe the small investors or the central banks is a different issue, but the small investors in gold or the other people out there that are holding it, I believe you've got to get to a point where they say something else is better value. Like you could buy the Dow with 1 ounce or 2 ounces, right? Or the Australian stock market. We run this ratio for the Australian dollar gold price versus the ASX, the yen gold versus the Nikkei. There are points where people who own gold are going to go, shares are on sale if you own gold, properties on sale if you own gold. That's what happened during the Asian financial crisis. So out there somewhere, there's going to be a lot of gold come out, and we're going to see the kind of volatility and mess on a scale higher, I believe, than what we saw a couple of weeks ago when silver had its little moment, when, again, the plumbing just couldn't cope with the volume that started coming through. So, but that's all ahead of us. But at the moment, it feels like, the trajectory is good, and as much as it's expensive to the average wage earner, it's not expensive to the average corporate investor or the person might want to make a portfolio allocation. And let's be clear, no one's selling all their shares in the Dow or the S&P to buy gold. They're allocating 5% of their portfolio or 10% of their portfolio or something like that. There's not enough gold to cater for everybody. And if everyone tries, it'll go so fast that the people that hold it will say, well, whatever you're selling, I'm going to buy in return, right? Pity the person that, bought gold at 800 when you look at what they could have done in the future. If they'd bought the Dow or bought bonds back then when they were yielding 12 or 13%.
Yeah. Oh, because I actually looked the other day. I'm like, I wonder if the US sold all their gold in Fort Knox, what that'd do for their debt. But I think considering they got 30 odd trillion of debt, I think it's about $800 billion worth of gold in Fort Knox. So it doesn't really move the needle. So I don't think that's coming into the market.
I think it would need to be $30,000, $40,000 or $50,000 an ounce or something, and then they sell it for whatever, right? So the other big thing, and I'll get to why I think that everyone always talks about US dollar is important, and I should say, by the way, these backgrounds, this red and green, this is our internal Noah's Rule scoring system, and that's the weekly score. When the weekly score is negative, the background's red. Now you can see the US dollar has been pretty choppy in its uptrend for the last 16 years now, since 2010, but it's been basically trending up, but with these various sell-offs that are marked in red.
Is this the DXY,
what we do know,
Shawnee? Is this the DXY?
This is the DXY. This is the US dollar index,
Mate, I watch heaps of Bloomberg these days. I'm all over it.
Yeah, all over it. And I've got a line there at 100 because I think, again, 100's a reasonable kind of mid-rate. Things have tended to get a bit interesting when it's moved through that level in the past. You can see there's a lot of highs or big breakdowns have occurred through there. And if you look right on the left, you'll see that we went from red to green after an extended period in the 70s, Volcker put up interest rates, and you can see the dollar index went from under 90 to over 160, right? That's the dollar getting strong, which is another reason why gold fell. So that period and the period from 95 to 2002 are the reason people say dollar goes up, gold goes down, because most people, we saw those periods that they were enjoying that. And then the red background from 02 to 11 there, dollar went down, gold went up. So we know that it does have quite that strong inverse correlation, and it's obvious, right? It's the other side of the other side of the trade, gold versus dollars. What's been very interesting and confounding a lot of people is that dollar's basically been going up pretty much since 2014. You know, we broke out of that base, had that big rally in 15, and it's been volatile, but it's been trending sideways to higher. So gold's actually been rising in an environment where dollar's been going up as well. And it can do that. You know, again, there are periods of time where we've done that. And one of the things that's been fantastic for Australian gold investors and fantastic for Australian gold producers is that generally rising US dollar has meant a generally falling Australian dollar. So we've had an Aussie dollar falling while gold's going up, which is why the Aussie dollar gold price is so sensational today, right? I mean, it's really quite remarkable. In 2011, you know, when it got to 1850 US dollar gold on the highs, Aussie gold was about 1650, 1700, because the Aussie was at 110.
Yeah, phenomenal, wasn't
So
it?
we've been massive beneficiaries of this funny thing. Now, this next chart is something that people are just simply not going to see anywhere but us. The marking, this is very much our internal work. And so this is going all the way back to the 70s now. That's US dollar gold. Again, that arrow shows you, where the kind of that 75 moment. And just note there that the gold price in 75, 76 halved. So when you asked about whether it's going to 4,000 or 6,000 next, even if I believe we're in the early 70s, there could potentially be a 50% retracement somewhere between a high we see and the ultimate high. And that's something that, I think is quite scary, particularly for people silly enough to trade CFDs and do it live on TV, Maddie. But what we've got there is that's the US dollar gold price. The 200-day moving average is the green line. The 200-week moving average is the darker line. So we just like those for broader trend. But what the red marking is the red marking there is when those previous two charts, if dollar has a green background, so dollar is rising, and the Dow Gold has a green background, so equities are outperforming gold. So both of those conditions have to be in place. If both of those conditions are in place, our chart wizard, organise this so the line turns red. So it's the gold price overall, but that line is red when both of those conditions happen. US dollar is in uptrend, green background on our scoring, and the Dow Gold has a green background. And I think it's fair to say that you can see that if you avoided gold, during those periods of time where both those conditions were in place, particularly where they were both in place and the gold price was below those averages, that would have been a very sensible place to do. In fact, being short would have been fabulous, and you certainly wouldn't want to own gold mining companies. So that to me is very interesting. Now, the interesting thing, just to reinforce the point before, that when the line is blue, one of those conditions, US dollar can be rising, but if US dollar is rising, gold has to be outperforming equities, or vice versa, right? So you can have one condition, but the minute you get two, what we talk to our clients about is dual headwinds, all right? Now, the obvious question then is what happens when you have the reverse like we have right now, when you have a red background on both? And I like to joke that we don't really want to show our clients this because they don't need any encouragement, and nor do I, my investments. But this is the reality, that we're sitting in this kind of GI cordial green kind of place where we have dual tailwinds. And so in terms of thinking about what could go wrong, and you should always have plan B, like where is the exit? And again, this doesn't work too well for wanting to trade on stops or trading CFDs on a short time frame. But if you're looking longer term and trying to run a gold mining company or trying to put some insurance in your portfolio, then while this line remains green and really while ever it remains blue, you're okay. I mean, you should be trying to hang on to this, in my view, trying to stay with this trade until you get those dual headwinds. Now, there could be some quite nasty corrections along the way. Again, coming back to your original question, and we'll get to more detail of that in a minute. But in the 1970s, or before we had actually that coding isn't there for the early part, but you can see there was a 50% retracement then. In the 2000s, which is we started Noah's Rule in 2004. I finished up in banking, and then so I was still in Rothschild in the early parts there where we went green. We came up through the 200-week. You can see it was great, and we ran up to 86, and then 88, and then 2011. In all three of those spikes, you can see the three core spikes there. We had between 15 and 30% retracements in the price. Again, this is a log scale. And in 2011, of course, after we peaked out, the market fell from 1850 to 1050 before it finally bottomed out, right? So, and it did go red very early, gave you plenty of warning that the dual headwinds were coming around and changing. But I think, at the moment it's green, and as much as it's confounding people who tie gold to real rates and things, I'm happy to stick with this dual tailwinds model as a fairly good sort of guide of where we are.
What do you think's the biggest first leading indicator when do you think that it may be not a dual tailwind?
Well, I mean, at the minute we lose one of those, so equities start to outperform gold, that would take us back to blue, or the dollar starts to go up. Of those two, I would think that if we have some kind of crisis, the idea that the money might run back to the dollar, I think I could more likely imagine, I could much more easily see the dollar going back to a green background and getting back above 100 than I can. I think the equities strongly outperforming gold, Matty, of the two. Right?
So, and when you say equities, you're saying like just the Dow, like general equities, not gold equities.
I'm talking about the Dow, but I'm talking about the Dow as a proxy for all equities because they're all pretty highly correlated.
Yeah.
If you look at this chart, so that's the same chart again. Again, just trying to figure out, part of our thing with our scoring is you can have the background red or you can have the background green, but when the background's green, it can get up to a score of +6. And that seems to be, that tends to be associated with highs, and we're at +5.9 right now. But we went back and again trying to compare the current environment, Matty, to the 70s. Again, I find that we have to go back to the 70s to do it. What we're looking at here, those red bands are on the chart wherever the gold price is more than 70% above its 200-week moving average, which is the dark brown line, and more than 20% above its 200-day moving average, which is that green line. So just trying to think like, markets get, and you would know this with shares, you're going along and shares have a spike, they get too steep a sort of a run, not surprisingly, they're going to correct at some point and come back more to the sort of the rate at which the average is getting up. So we're not trying to turn people into technical traders, but we're trying to compare the current price to the price on average over the last 200 days or 200 weeks. And what you can see is we had long periods of time in the 70s where we were in this condition. And what you can see is, there were some pretty interesting corrections when this condition ended, but it didn't nail the 1976 high, but it went on a little bit higher after that, but then it did have a 50% retracement. The 1980 high of 800 is absolutely in the middle of that second big cluster of red. And then you can see the high in 2006, the high in 2008, and the high in 2011 all had this condition for a very brief period of time, all right? And in terms of the length in days, in 2011, it was only 1 day, and then it came back a month later and it had 3 days. So there were 4 days in total in 2011 where the market got this far away from that kind of what I would describe the gravitational pull of the averages. You can see back in the 70s, it was measured in hundreds of days. And so recently, in September last year, we first hit this condition and we were in it for 23 days. We dropped out for a couple of weeks. in November. We were in for 4 days, dropped out for a couple of weeks, and we're back in again until the 11th of Feb. And this is when this chart was done. From 11th of Feb from the 26th of November until the 11th of Feb, 56 days in this condition, and we're in this condition today. So we've now been in this condition at this time longer than any period in 2006, 8 or 11, which is why I said right at the beginning, you have to go back to the 1970s to find periods of time where the market could sustain itself in this way. And what is this saying? This is just saying that the buyers turn up every day, they buy, they go to bed wherever they're buying, in India or then in London and then in the US, and we go around the clock and everybody has their go, and they come back the next day and they buy again. And we had the little infarction a couple of weeks ago, and the gold price got, crazy into these levels, much higher than these minimum levels, much higher. And it fell, but it fell back only to around these levels, and it's back in these levels again. So the buyers got ahead of themselves, but overall we're sustaining this level. So the first warning sign to your question, long before we lose dual tailwind, is losing this condition. And we call this the death zone. So it's a bit like when you go mountaineering above a certain altitude, nearly all deaths occur because people run out of oxygen. So the market really struggles. So right at the moment, I don't know what the oxygen is that's feeding the gold. I don't know who it is or what it is. I don't care. But at the moment, there is oxygen feeding this rally. And the first sign that that condition has changed might be when we lose this sort of level of stretch. And then we need to be careful, because remember, from 2001 to 2011, that was lime green for 99% of the time, right? So we had these peaks, and it pulled all the way back and had like that very significant correction in 2008 during the GFC. We were lime green for that entire time. And we just go back there for a second, Can you see my mouse?
Yeah, mate.
There's like a tiny little bit of red for a couple of weeks just in there. And otherwise we had green, we had blue, we rallied. We lost the green here, but, we never lost the blue and that whole rally. So, if you think about it, and this is just one way of looking at it, but, we could have significant corrections. And I certainly, the idea that gold price, if I went away on holidays for 4 weeks and came back and gold was 30% lower, I mean, you go, okay, well, that's a pain in the neck, but we shouldn't be surprised. I'd ask the question why, and it would have to be dollar went through the roof because of some reason, or there was a stock market crash and the stock market's down 50 and gold's only down 30 or something like that. It's not just going to do it on its own. It's going to be in concert with some other things. But given the world that's going, in the 1 hour and 46-minute State of the Union address last night about everyone complaining to Trump about he's doing too much good in the world, who knows, right? It's a very uncertain time.
It's fascinating that that gold retraced 20% and still satisfied that condition, which shows how steep it is ahead of the moving average. But if that condition will pertain, gold's going to have to keep ripping a lot, because that moving average is going to catch up very quickly because of how quick gold's going to go. So if that means gold could really keep going up if that condition stays.
Well, it has to. This is the point. When these conditions are like this, it needs it. It's like a plane that's got an afterburner. There's no aerodynamics involved. It's an afterburner. It's burning fuel. It's a rocket, right? But the afterburner chews up fuel very quickly, and so at some point, when you run out of fuel, you're back to being a plane. You need normal lift and drag and the normal aerodynamics. It's the same thing. And we often liken these rallies. So if you dig into gold now, just looking at the scoring of gold, you can see that our weekly score, very briefly during the global financial crisis, actually went from red to green and broke that rally essentially into two parts.
Yeah.
And gold fell well below the 200-day moving average, but never got anywhere near the 200-week moving average. So that long-term uptrend where we had the lime green was there. And interestingly, that little patch of red was in here somewhere. We went sideways for quite a while. Gold never went back, but those other conditions changed. Now, the reason I put this slide up is just to show you that this latest period of green, this latest period of scoring is 167 weeks. we've been a lot. This is still only the fourth longest of the rallies since 2000. So this is not a long time to have a positive weekly score. We've been a lot longer. In another 6 months, we'll be the second longest. But if you look at the distance traveled, we're already the second longest at 177%. And again, to the idea of retracements, Matty, and being concerned about how far it could go back, those boxes are the percentage gain to the high in the period of green and how high we were when the green ended. And you can see we went from up 265 to up 210, up 129 to 94, up 62 to 44. So towards the end, once you've made the high, you can shed a long way. So when that period of the death zone ends, the risk of us then having that retracement to the end of the broader period is there. What's far more salient for people on this call and for producers in Australia is if we look at the $8 gold in a similar lens, at 176 weeks, we're only 4 weeks off breaking the record that was set between 2017 and 2021 for the biggest kind of move, the longest period, without any kind of correction. And if you look at the distance traveled, we've gone 179%. We're getting close to twice as far in one of these periods. And this is because the $8's been going down and gold's been going up. And that is not usual in a 30 to 40 year time frame. It has been far more usual in my working life that it's only about 15% of the time that Aussie's going down and gold's going up. So we've benefited enormously from what we call purple patch, falling currency, rising gold, and our producers have benefited enormously from that. And a lot of those little red lines have tended to be when the Aussie, not when the gold corrects so much as when the Aussie rallies and plays catch up and drags it back. But that's the risk to Australian gold investors and to Australian mining companies. We get a little bit of a gold correction at the same time we get a bit of an Aussie rally, and you can shed a couple of $1,000 off the Aussie dollar gold price, pretty quickly. And, again, no one should be surprised when you look at those stats. We have run, we've run between 5 and 6 and 7 times longer than some of those other, percentage moves we had before we had one of those periods of red. And some of them were only trading sideways for a while. They weren't necessarily life-threatening, but, the idea that we could trade sideways for a while here as gold goes up. And I pointed out in Fremantle, Matty, and it's worth making the point here that in 2001, we got to about 600 Aussie. And in 2005, we were still at 600 Aussie. And if we go back to that previous slide, in that same period of time, the US dollar gold price went up 70%.
Yeah, right. Interesting.
So we've had a situation in the past, in the not too distant past, where Aussie dollar gold price has gone sideways while US dollar gold price went up 70%. If you're an investor in gold shares, you would want to have some US dollar cost-based producers in your portfolio in that environment, because they're going to be seeing massive margin expansion as Aussie producers are just standing still, and in US terms going backwards in terms of their operating margins. The price is still good and they'll feel good about things, but that's a challenge, which is why we've been recommending our clients look at buying calls on the Aussie as probably the cheapest protection they can get from what might go wrong in their business. Not so worried about the gold price necessarily, but the potential for the Aussie to take the punch bowl away from the party has to be considered to be, reasonable.
And that's on a cash flow perspective, but it's amazing how the equities, the Australian equities that are making their money in Australian dollar gold price, seem to just correlate in line with the US dollar gold price because of all the GDX flows into those stocks.
Absolutely. And even before the invention of the GDX, mate, and other things similar, US dollar gold price always drives sentiment. There's no doubt. US dollar gold price drives sentiment. But when people start to screen companies, if this happens, if you get into a period like this, and I remember talking to a producer in that period in Brazil, and the Brazilian real gold price had gone sideways for 5 years. The Brazilian real was 70% stronger against the dollar over the period, and gold was up. And his share price was getting absolutely hammered. And he said to the fund managers, I'm making the same amount of money I was making 5 years ago. He said, yeah, Brazilian real you are. But he said, like the US guys, they're seeing all the margin expansion. In US dollar terms, your margins has contracted, right? So they're mercenary. If they're not Aussie dollar based investor, if they're a US-based investor, they're going to be very conscious of that.
It's interesting thinking about it now, and you can talk to me about how you're, once you get to it after this slide, but I want to know positioning during this time when you're like, God, it could go higher, but like in relation to what is, because it seems looking at it now, it's like you'd nearly be long the metal, short the equities to possibly protect yourself, because it's like the equities are going to fall harder than the metal, which is I think what we saw on that previous retracement. But how are you thinking of that?
Well, yeah. Look, it's a really good point, and there's so much misinformation about that on the web. But let's. I don't actually have a chart directly about that, but let's absolutely chat about that. But just quickly, I guess the point that I would make here, and I made in Fremantle, is have a good look around at broader mining investments, because gold is outperforming a basket of commodities to the extent that gold is as expensive relative to a basket of commodities as it was at the COVID highs when we got to 2000 and when we got to 800 in 1980. So again, this idea of where we are, like it's gold is gold expensive, or are those other things ridiculously cheap? I don't think gold is necessarily expensive relative to equities, as I pointed out. So I think the other commodities are ridiculously cheap, and we'll get to that. There's absolutely a chart about that. So to the extent I'm taking profits on gold stocks from a PA perspective, I just bought like an ETF for oil service providers, and I'm looking around for oil and gas investments. I was at a lunch yesterday for an IPO of a little gas company in the eastern states. I'm going to places I don't fully understand. But I know that when you can buy 70 barrels of oil for an ounce of gold, that if there's a mean reversion there and it's not gold coming back, it's going to be oil going up a lot, or gas, and maybe a bit of both. So, and certainly in terms of our advice to our clients, we've been saying to them, why would you not try and do a swap gold for oil and pay for, like book up your next 3 years of diesel and pay for it in gold? And there's a way you could do that. You could construct that with a bank. And if you think about it, like if a mining company stacked up all the gold bars they made every year in a pile and said all of the money that we went in just to make this little tiny pile of gold bars, and we've never had to take less gold bars off the pile to pay for the fuel bill, I think that's a good swap, right? That's a good trade. So that's what I'm doing with my personal portfolio, and that's what we're recommending mining companies do. It's a bit more difficult for them to do because a lot of institutional investors go, oh, you're messing around at the edges and just stick to your knitting. But really,
their heads would be blowing up listening to you sometimes, wouldn't they?
yeah, sometimes. So from my perspective, I think, and copper, sell gold and buy copper. Look at the gold copper ratio. We've written about this to our clients. A really good example, Matty, and I spoke about this at one of Kerry Stevenson's gold conferences last year, as the gold silver ratio got out to 100 to 1 in the middle of last year. I said, if it gets out to 100 to 1, I'm going to swap my gold ETF into a silver ETF. And that's exactly what I did, because I imagine in my mind an Indian person walking into a gold shop in India and seeing a record high rupee price for gold and a record high rupee price for silver, and having no choice but to buy one or the other because they never save in rupee, they always save in precious metals. And them looking at it and going, well, they're both expensive, but hang on, silver's never been cheaper relative to gold, so I'm going to buy silver. Because I remember there's an uncle I had who used to always bore us at the parties telling us how he sold 20 ounces of silver and bought an ounce of gold some way back in history, how clever he was. I'm going to buy the 100 ounces of silver. And we wrote extensively about that to our clients, and called silver the 100 to 1 long shot around the time of the Melbourne Cup, as recently as that, and said it's like coming around, everyone's watching gold, and this silver's just coming around the outside. And silver outperformed gold by a factor of 2. And when it stopped, it was at 50 to 1. It had been 100 to 1, Maddie. So to my mind, this says take some profits on gold and put it into other commodities that are relatively cheap. And copper's a lot cheaper than relative to gold than silver is, but silver's still all right. And a whole range of other things besides, right? So, and oil is the cheapest of the lot. And even like fertilizer and stuff. Like, I go and get advice from that, but I'm looking at food and what could happen there. I just feel like that's what I've done to try and insulate myself, or any new money I'm putting in, I'm not putting it into, say, gold producers. I think the other thing that people do, and I don't know about you, but I look at it right now and I look at like Gorilla Gold for one of a better example, or
current holding.
Ballard, companies at this level. I'm now Ding Ding is that the thing. I own both of those.
Well,
PC
I own
Gold.
Delta, so I own 34.4% of Ballard.
Yeah. So I look at those companies and I think the cost of finding gold has probably gone up 20% in the last 2 years. Cost of drilling, cost of labor, whatever, maybe 20%. But the size of the prize has gone from a $500 operating margin for mining to 2 or 3 or 4,000. But so that's, to my mind, that's where the real value is. So that's the way you insulate yourself also from a correction in the short run, that you buy those things that, in-ground inventory. And I don't think the Chinese disagree, Matty, with that. They just went and bought Allied Gold in Africa. right in that week when the gold price was having all the problems and silver collapsed, they turned up and paid $4 billion cash for gold mines in Africa. Now, they can't buy it fast enough in the market, or they're driving the price too high. They're buying in-ground inventory for fractions of that. We should be doing the same, I think. So that's what I'm doing too, as a sort of a barbell strategy. And we're working with a lot of these little companies that are coming into production, and they're very lucky. They can just buy puts and lock in profitability and go hard. So it's kind of a nice environment for the juniors. So I think there's good pickings down there as well, mate.
Yeah, and because that's how I'm approaching it as well. I've got, God, the only producer I've got long is Ramelius. Other than that, it's developers with growth and catalysts potentially, and short the Nasdaq and short Bellevue at the moment.
With a sprinkling of Simon Lawson in Ramelius, bringing more of maybe an exploration thing into what was one of the best operators in the space. I think that's an interesting hold. I mean, I'm a shareholder of Ramelius. They've been a client for a long time. I think it's a great company, but I saw Simon's presentation in Fremantle, and I'd be amazed if people weren't walking out of the room and buying shares there and then in that company, when you just look at the potential under all of their existing mines and just the way they're going about things. So very interesting. Sorry?
Can promote.
Yeah. But that's what those conferences are for, aren't they?
Yeah.
But I think it's fascinating to me that the gold price can go off quite a long way, and these miners are still going to be very profitable. Can we just come back to your other question, because I think it's a really interesting one. I would not be short miners, long gold here, because I think even if gold comes off, mining companies are going to make a lot more money. And I think a lot of equity investors who feel the need to have gold exposure, Matty, feel more comfortable in equities than they do buying gold, even though there's the ETF. So I think at some point we'll be there. And there's a lot of misinformation, I think, on the web. If you go and read on the web, everyone says, miners always underperform. And you can look at it, a ratio. I don't have it, sorry, but the ratio of like the GDX or the GDXJ to gold mining companies have, it's a fact, underperformed the gold price for most of the last 15 years, with exceptions, right? Like, I would never buy a gold mining company that wasn't outperforming the gold price. A lot of people do. And you can do that just by dividing the gold price by their shares and, looking at the ratio of individual companies, right? But if you look at the index now, why is that? Well, this is my kind of take on it is you've got to go all the way back to the late 1990s, when people were doing ridiculously stupid amounts of hedging, like Sons of Gwalia and all the stories you hear. And in the year 2000, let's start there, gold producers are short 120 million ounces of gold, which is equivalent to 1 year's production. So just as gold is never cheaper by the Dow Gold ratio, 40-1 from 1-1, just as we get to that point, gold producers had the biggest short position they ever had. They'd forward sold the equivalent, about half of the companies had between them sold the equivalent of 1 year's gold production.
Yeah.
And then Pierre Lassonde bought Newmont's hedge book back at a profit. It was in the money. He was the first one. And everybody else bought them back at a loss. And Newcrest, I just remember the numbers. I pick on them because they're dead. They spent $5 billion buying gold in the market to crystallize a $2 billion loss on their hedging that they funded through issuing $2 billion of new shares. Jesus. So think about that for a minute. Newcrest didn't add any to their in-ground inventory, helped to push the gold price higher, and had more shares on issue. That can't be good for the investors of Newcrest, right? And so a lot of mining companies did that. So during the 2000s, mining companies were issuing paper to buy gold, to buy back their hedge books. So they were contributing to the rise in the gold price, and they were expanding the number of shares on issue. Then we got towards the highs and everyone got excited and everyone was totally anti-hedging, and the fund managers were all telling them in 2010, 11, 12, do not under any circumstances do hedging, right? Some like Perseus and others didn't listen to them to their great benefit, but the ones that borrowed and didn't hedge, and that was most in North America. Then you had the collapse in 13 when all the investors saw the Dow Gold ratio going up and said, oh, great, we can go back. It's safe to go back to gold because there's a green background. And we'll just go back there quickly because you can see it as clear as day. Sorry. This point right here, we go green early and we come through. At this point, there's not a fund manager in the world who's been long gold for the last 11 years that isn't going to the investment committee and saying, let me go back, sell the gold and go back to general equities where I feel more comfortable. And we all know what happened in Q2 2013, right? And other people besides are doing, and we know the Chinese were selling all sorts of people. So gold producers bought back hedges all through here, borrowed enormous amounts of dollars here, didn't hedge, and then this happened, and we know what happened to the gold price. We saw this very substantial here in our weekly scoring negative. We had this big sell-off. And all through this period, Matty, then what happened is gold producers issued more equity to repay the debt they couldn't afford to repay with production because they were performing so badly. And right through this period, as the gold price went down, we had more equity issuance. So they were issuing equity to buy gold here, and they were issuing equity to repay debt here. So when you look at that ratio chart, it just looks terrible because they're just issuing more and more and more paper, but there's no more gold in the world other than the little bit they added, right? So you were better off right through that period to own gold. What I think is fascinating today, and again, why I'm very happy to be long gold stocks in my sort of retirement fund and whatever, is there's really not a lot of debt. Gold producers really don't have a lot of debt. You look at all the cash they've got on their balance sheets, and there's no hedging. You know, at this point down here, mate, in 2000, there was 110, 120, probably more with derivatives, million ounces of hedging. Today, there's less than 8 or 6 million in the world. Right? I mean, Northern Star probably accounts for 25% of the entire global hedge book, maybe a little bit less than that. And maybe there's some stuff we don't know about. But let's say at its wildest, it's 10 million.
Yeah.
So less than 10%. So we don't have any hedging for gold producers to issue equity to buy back. We've seen a little bit of, people using cash to buy back, like Volt recently, So they just announced their quarterly. That's all done, as you know. Well, they announced before, but their quarterly came out today and talking about that. So, they've used cash to do that. So no one's issuing shares, and people are now talking about buybacks. Even Pantoro, that were having a really tough time 2 or 3 years ago. Fantastic, right?
So what? Because what you got Pantoro, Westgold, Ramelius, Volt. Who else is doing a buy? There's a lot of buybacks in action at the moment.
So let's think about that. So we've got a situation where gold producers are more likely to be buying their shares than issuing them. Right? They're drilling like the blazers, and if you saw Simon's presentation, and it would be similar, there's lots more gold to find. When I first went to a gold mine, there was the Gidgee gold mine, Arimco. Went to my first mine site visit. I was quite surprised to see the holes in the side of the pit where the old shafts were for the underground mine, right? Like in the 80s, all people did was dig an open pit where there used to be a mainframe and an underground mine, right? I saw Bill Beeman last year speak at lunch. Always fantastic to watch. Enthusiast that he is, at a lunch in Diggers last year. And he said, it used to be where every head frame there's an open pit. Now everywhere there's an open pit, there's an underground mine just waiting to be developed. So I think, you look at the potential for the people to hold their level, their gold backing of their shares there. And if they buy their shares back, then the gold backing of their shares improves, and there's not a lot of debt. So I think the reasons that ratio performed so poorly in the past don't exist. there certainly exists the opportunity or the potential for the gold price to correct substantially for reasons totally out of our control. But I wouldn't, I wouldn't want to put that trade on, certainly not at these levels, because I do think that gold price goes sideways for a while or even corrects. Gold producers can still look, very good if they keep their margins under control. So I wouldn't want to be short gold mining companies until we really had dual headwinds. And in that environment, you could imagine being long gold and short miners might be all right. But, again, that's not really the way I like to play things. That's a bit complicated.
Yeah, you definitely have to be selective on that strategy, because like you look at all the half yearlies that have come out. So between Volt, Westgold, Ramelius, Regis, like they're all got over $500 million in cash. Regis has nearly got $1 billion.
Yeah.
And it's phenomenal. Whereas the likes of Bellevue, Orabanda, now Genesis as well, after the magnetic transaction, like they're not sitting on those big cash stockpiles that the other companies are.
Yeah. And at some point, so I just feel that whoever they're going to buy, or what's, so I'm trying to figure out, to the extent in many cases, the shares I have in the producers I have because I was long the juniors that they bought, right?
Yeah.
And took their paper and accumulated over time. So I said in Fremantle I would describe myself as irresponsibly long gold in my portfolio if you did a kind of a pie chart of the allocation to gold. But that's only because some of the stuffs that I bought 5 years ago have done so well that I actually have a portfolio worth talking about, Matty, because as you like to remind me, I have been married twice before. And,
I thought it was three.
I've halved my net worth 3 times in my life, twice through marriage and once through entrepreneurial misadventure. So, I do need to make this next run work, Matty. And I did invest quite a lot in gold 4 or 5 years ago. And it's, some of those companies have, good companies have 10 bagged or more. So to the extent I have a portfolio, it's only because I've been invested in gold and I don't believe it's over. And maybe to draw it all to a bit of a conclusion, because I'm conscious of the time, this I think, and I put this chart up at every RIU in Sydney for the last however many years, this chart was really popularised around the time of the red circle, right? In May, with great excitement, the In Gold We Trust report will come out. Ronnie Stoffel and his mates over there in Liechtenstein will produce their annual gold report. And, it's always fantastic reading. And they kind of popularised this ratio that we were getting down to the fact that around that time back in 17, that, commodities were radically undervalued relative to general equities. And they put up a chart about the same time frame as the red-green chart. And I'm always concerned when people put up a chart with a relatively short time frame, what happened to the left? And with the help of some friends of mine, they found this black and white chart down in the bottom left-hand corner that goes all the way back to 1917, looking at this ratio. And so that's the ratio. You wanted the S&P, Matty, you've got the S&P now. This is the S&P versus the GSCI as they've rebuilt it. And above that top dotted line, commodities are radically overvalued relative to equities, and below the bottom dotted line, commodities are radically undervalued relative to equities. Now, what's interesting, I think, couple of things, is the first brown arrow. That's where we were when that gold wages thing spiked in the 1930s, right? So we weren't in the top half of that zone, but we were well above radically undervalued. We'd been radically undervalued in 29. You can see here when that gold wages thing got down on the lows, that's where we were. We got up to here, right? We're up at 0.4 to 0.8 on this graph. That's there. Interestingly, this blue circle then takes you to the fall of the Nifty 50 in the 1970s. That was their version of the Mag 7. Commodities had been radically undervalued for nearly 20 years under this line, but keeping pace with, if the ratio is going flat, it means commodities are keeping pace with shares. And that's during the Nifty 50. So commodities did all right during the Nifty 50, but when the Nifty 50 collapsed, equities collapsed, right? And we ended up at the top. And that first blue arrow is where James and his mates were $200 push bikes in the park, right? So that's 75, and we got to the top. And you remember where the Dow Gold was at the time. You remember where gold wages was at the time. We were at the top of that chart. And then the next red arrow, well, that's when the gold wages actually peaked in 1980, right? So that's that other peak a few years later. So remember, the gold wages ratio now is even higher than it was in 1980, but we're at the other end of the graph, and we're at the other end of the graph so much so that if this graph finishes in 2017, I don't have the data to update it. So we've now recreated in the nearby, and since this graph was popularized, they only got more radically undervalued, right? And then they rallied, and we had that rally out of COVID, and then they came off again, and this is where we are now. So this red arrow is like down here somewhere on this chart, and the last two times we had these gold wages peaks, we were well into this zone or at the upper end of this zone. I could also, you could look there, anyone looking at these charts can see that these peaks were all associated with crises, and this peak was associated with the absolute commodities blow-off in about, we had it leading into the GFC, commodities versus equities. So up into the GFC, this is our high at 8. Now, just think about that for a minute, and this drives certainly my thinking and why I'm happy to be sort of, irresponsibly long gold, but looking to add other commodities and sell gold to buy other commodities, Maddie, and why we think, our customers should be behaving the way they are in terms of buying calls on the Aussie and trying to buy their fuel with gold, is because the GSCI is about 50% energy and the rest is a combination of food and metals. And even if it doubled, even if the GSCI doubled here and equities stayed unchanged, or equities halved and commodities stayed unchanged, this ratio would still be below that point in 1998 or that point there. And I made the point in Perth recently that I lived in Perth in 1998 and it was dark. Mining was in the toilet. Things were bad. The gold was at the end of that long cycle. The Dow Gold was 40 to 1. It wasn't good, but it got pretty good in the next few years as that ratio turned around, and we had a fantastic time through here. So this is the thing, like, it feels pretty good in Perth at the moment because we've made a bit of money in lithium a few years ago. Now we're making good money in gold. Base metals are starting to come back to life. But you look at it and things are going okay. But, wages are not great relative to gold. Gold is still relatively cheap relative to equities. And you come around to all of this, and what you really, I think, come to the conclusion, Matt, is it's not that commodities are necessarily cheap, but the general equities are radically overvalued, because that's the way you could rewrite that chart. The people that made that chart are a commodity fund manager called Goering and Rosenswatz. Great website, Go Rosen, www.gorosen, Gorosen. They write fantastic research. They give it all away for free. They're commodity people, so they put that chart in the terms of commodities are radically undervalued and commodities are radically overvalued. But you could just as easily write those lines and say equities radically overvalued, equities radically undervalued, right? General equities. And I believe that absolutely to be the case. And so there is the issue here that, again, in terms of a portfolio, where's the money coming from to build all the mines that we think we need to drive the AE revolution? Where's all the money coming from to grow the mining industry and come back to some of the joy and things that we had in the 2000s? I think it comes out of the smart money in equities going, this AI dream doesn't happen unless we produce more copper, produce more ever. Friedland, gets in people's ear. The people with lots of money are the people that actually realize how much commodities they need. The people who've been making the most amount of money in the last 6 years are figuring out that without commodities, their vision never happens, right? And so I think that the idea that we're going into the rotation here is high, but it's still got a red background and we're still under that long-term moving average. So it's got to prove itself. But I think that, if you imagine we're somewhere like in here, and this is when the Aussie went from 50 cents to parity. This is when oil went from $30 a barrel to $120 a barrel. I believe we've had the first run up. We've had a bit of a dip. And if this was a junior stock and you knew the fundamentals were good for it, but it had just been trashed out because everyone's lost interest. I think that's what commodities are in the world. In the world of investing, I think the whole commodity sector is like a trashed out junior stock that everybody else is making money everywhere else doesn't even want to pay attention to, but they're going to have to start doing that soon. And BHP just made new all-time record highs, Maddie. So people are waking up in the bigger stocks and buying in. So I think this is my kind of guiding light, this in the Dow Gold ratio that says, if you want to be in things that are cheap but have potential and the world needs, and you've worked down in those bloody mines, you know how hard it is to drive a jumbo and do all that stuff, and actually how hard it is to make these metals. The world's just become very digitized. Everyone thinks you can just do everything with AI. Well, there's some things that you can't. And so I think hard work comes back into fashion. And when it does, that's where we go. So that's how we're playing it and how we're trying to help our clients manage through. We're in the right place, and it feels like we're early. I mean, you could 10 bag something from here, and with the ratio, it'd only be back at 2. And just as you think you're clever and you're taking your money off the table, some foreigner who's new to the space is only just getting interested, is only just getting on their radar.
Yeah. Mate, sensational. Jeez, it's given me some stuff to think about. I've got to bloody re-watch all this. I'll be. There might be some modifications on the old portfolio you'll see on tomorrow's market open, mate. And you'll know it came from you. No, I'm quite comfortable. I'm quite comfortable at the moment, actually.
Yeah. Well, if you want to blow your mind, the other thing just very quickly is, this has been my kind of guiding light for what other metals to go to. And I got into tin a while ago, and that's been very good. Tungsten, nickel obviously has been a bit of a hard grind, but silver, these are the most disrupted by EV. And this is the path since that slide came out. Now, what is amazing to me, but it shouldn't be amazing if you think about it, Rio and MIT went off and did all this work and identified what would be most disrupted by EV. But because EV's been going so well, investors really haven't paid attention. They've been still chasing the things that are running, and mining wasn't. But in the meantime, we had a bit, had the vanadium run, we had the nickel spike, we had tin did well, obviously had the lithium boom. But, Reg from Canaccord opened the conference in Freo talking about the everything boom. I closed the conference 3 days later with this slide and said, well, yeah, I mean, it does feel a bit like an everything boom if you're in tin, gold, tungsten and silver. But again, we can't say that, no one can say they were surprised and all this critical metals thing when you think about that slide. Like back in 2018, and to Ken Brisden's credit, he's the first person I ever saw put this slide up in a lithium and the first go round in Pilbara, I'm in this space because this is going to happen, right? And he's still in that space. And but I remember just sitting and looking at this slide when I saw it in Sydney and going, I know nothing about lithium and cobalt, but tin, silver, nickel, gold, they all have futures markets. And what I do know, Matty, is when consumers are competing with investors to buy metal, so mining companies have the benefit that investors are buying their metal and so are consumers. That's when you get big bull markets in commodities. But the miners have to remember that at one point your customer then becomes your competitor, the investors, right? So I think this has been, for me, this slide and really that one have been the two things that have sort of said to me, I've been in this industry for a very long time, but this is the best time to invest since the late 90s. So I'm having a go.
Yeah. Last question. I've got some self-interest in this question. I've noticed a bit recently, gold tracks tech a bit. NASDAQ was flying, gold's flying, NASDAQ pulled back, gold's pulled back. Do you see a correlation? Do you think if the tech bubble burst, what do you think would happen to gold in this current market today?
So I'm going to admit to you that I pay at my peril for the last 10 years, Matty, I pay absolutely no attention to tech. Between trying to manage my own life and my business and look after our clients, I haven't got enough time. So I don't pay a lot of attention. I haven't looked at gold, NASDAQ, silver, NASDAQ, that type of thing. I just look at Dow Gold because I think that's more stable. I will have a look. I will say, interestingly, tomorrow we decided that for our Friday feature for our clients, we're actually going to do gold Bitcoin and silver Bitcoin. and have a look at those, because a couple of years ago when silver went really dull, everyone said, oh, silver's dull because all the nutters that trade silver have gone off to trade Bitcoin. And I suspect that one of the reasons silver got so interesting in the last few years is that that they all came back from Bitcoin with a lot more money. And again, they were the right place to be, right?
Yeah.
But I think Bitcoin is a tech stock. I don't think gold. The fact that gold's correlated with tech in the long run would surprise me. In the very short term, it might be, mate. But
yeah, it seems to be.
Yeah,
I don't look back as far as you do. I'll get you to do that for me.
Well, you're not as old as me, mate. So, but no, I'll have a look and I'll let you know. But I think it's interesting. I read today from an analyst who I really respect, a guy called Charlie Morris, who writes the Atlas Pulse report on gold. He said Bitcoin's the most oversold versus gold it's been in the history of Bitcoin. So in terms of, having fallen relative to gold in a period, Bitcoin is as cheap relative to gold and by his measures at any time. And that was interesting because we'd already decided to look at Bitcoin gold for the clients tomorrow just for a bit of fun. But I'm going to be interested to see what that looks like.
The thing that doesn't give me confidence with Bitcoin is what we said before about the amount, if it's the debasement trade's a big factor at the moment and treasuries are being converted into gold. When there's such a small amount of gold compared to treasuries, you think some money would have started flowing into Bitcoin as well as, which it did with silver, platinum, palladium, but it didn't. Which
if you even believe in Bitcoin, right? And again,
that's what I mean. That's what makes me not believe in it, because I think if it was useful as a safe haven, money would have flowed into it, but it didn't. So that's the thing that doesn't give me confidence on it.
So my interest in doing it is not to tell anyone to buy Bitcoin, but is actually from the perspective at what point and there are lots of people who've made lots of money out of Bitcoin and crypto, right, over a long period of time. If they decide, like these guys at Tether do, that gold's a better place to be, Maddie, again, there's another source of potential money coming back across. If more people who currently long Bitcoin decide to buy silver, they can buy a lot of silver for a Bitcoin. So, this is the thing that I think is I'm looking for where the money might come from to sustain this rally, and then I'll be concerned about the rally in gold only when I can see that an average Indian or an average Chinese person or a central bank could find something better to buy with the money. They won't sell gold to go back into dollars because they have to invest in bonds. So you're going to need to see, high single digits, low double digit interest rates, or a Dow gold ratio, in low single numbers or something like that before a lot of the people who hold gold are going to go, it's worth my while going back into fiat and earning enough of a yield or buying good businesses cheaply that it's worthwhile. And we're still at the other side of that trade for that. We're still down here where commodities are radically undervalued. Gold is not radically undervalued relative to commodities, but at 10 it's still cheap or relatively cheap, but it's closer to its highs than maybe these others. But that's kind of the way I look at it, mate.
Very good, mate. Well, that's been an exciting marathon. I frothed on the whole thing, mate. I absolutely love it. So thank you. And I know you secretly enjoy it as well, Mr. Russo. You're a legend, mate. Thank you for donating some of your precious time to LEVRD. You're an absolute legend, as always. Great to get a proper chat.
Mate, great to chat and looking as fit and strong as you do too, mate. So
that's
all
that
good.
Bloody CrossFit, mate. Good for the views, good for the missus. Righto, mate.
See you,
Cheers.
Matty.
Legend.
Bye, mate.